Welcome, folks, to another Friday afternoon. We're joined by Chess and Wine, who has been with us a number of times. Always gives a great analysis. It's been a pretty volatile market out there today, Chess. Any thoughts?
Yeah, I mean, we know it's quadruple witching options expiration. We know we had a lot of fireworks yesterday. We know the Federal Reserve is not raising rates yet. Maybe they're trapped, maybe they're not. That's, I think, a point of contention. This morning after the gap down, it felt like the market was temporarily maybe a little hungover. And now, as we work through the afternoon, I mean, I don't know, maybe bears have kind of taken their, bulls have taken their aspirin and their Tylenol or whatever, and they might be sobering up. And then we might get a move here into the bell. I'm still expecting a lot of intraday I'm talking about now, very short term. We might get a lot of volatile, wacky kind of moves on this quad witching OPEX Friday, but I think the larger picture, to kind of zoom out a little bit, is whether this rally, this bounce, this grinding bounce, at times, squeezing, probably knocking out a lot of shorts on the way up since late August, since we saw that weakness in the market in late August. The issue is whether we've just effectively put in a lower swing high, a lower high versus we're talking about the major averages now, the S&P, even the NASDAQ, as impressive as some names are in there, like Amazon, like Under Armour, like Facebook. Even with that said, the issue is the NASDAQ, rallied, if you look at charts, right up to its declining 50-day moving average. And the issue is if we've just put in a major lower swing high, that bodes for likely a retest of those August lows, which are actually quite a ways lower from here, or maybe new lows. And I think the rally, the bounce, the rally, the recovery, the attempt by the market to heal itself since late August, here we are, and it's September 18th. And that, quote-unquote Black Monday that everyone was talking about back on Monday, August 24th, it's a while ago now. It's many weeks ago, and with the way this market's been in terms of the intraday action, all the news flow and the prognostications about the Fed, it seems like a good while ago. So, the issue, I think, psychologically is there this idea out there that many people are in denial that we can't retest those lows anymore. I think many people who were initially looking for that, and I think it's one reason why I really wanted to show a lot of patience on the short side when the last time I was on with you and Jack, and before that even maybe, because I didn't want to be one of these, they call that catching a flying arrow. When you short a snapback rally and it just keeps grinding higher on you or squeezing higher, and I think you want to, that's very bad, not just for your capital, but for your psyche as a short seller. So the idea was to wait and wait and wait for something. And yesterday we did get a reversal, and now I think we're in the midst of seeing, will that reversal prove to be something meaningful beyond just your run-of-the-mill shakeout, maybe pausing and then next week we continue higher. Beyond that, was yesterday a meaningful lower high. That, I think, is what we're in the process right now of deciphering.
Just to backtrack here just a tiny bit, perhaps you could just maybe expound a little bit on the notion of pinning. It's talked about a lot on the stream. I know enough about it to be dangerous, but you talked about today being a quad witching day. That is a number of different options are all expiring today, and the notion of pinning, and that is big players in the market really working the underlying stock to the to where they want it to be for their options to pay.
Yeah, I mean there's a lot. There's always urban legends. I think it's a very convenient excuse too. So I think you have to be careful with that. Right. Saying, oh, here they go, pinning it on. And I mean, maybe it's true, maybe it's not, but it is what it is, right? So I think you have to be careful not to fall, not you, Bob, but I'm just saying in general. I think one has to be careful falling into that mental trap. But typically, I don't think it's very controversial for me to say that we do see slightly, greater than normal market volatility on quad witching, especially into the final hour of the session. but it is what it is. It's just like everything else with high frequency trading, with everything out there. It's what I would say to anyone who's constantly complaining about that or saying it's rigged or this or that. My response would be, well, you knew that anyway. You knew that going into it. It kind of is what it is. I mean, so I just think today, especially Friday afternoon after yesterday's roller coaster with the big reversal, it's just something I think to factor in if you're hyper aggressively day trading today. It's probably something to consider into the close. But I mean, yeah, there's a lot of I think there's a lot of material out there in the blogosphere about options and pinning and that kind of thing. Is there a certain degree of noise maybe versus signal? Probably so. If someone can get a great signal off of pinning and options expiration, that kind of thing, God bless. But for me, I usually find it to be a little bit more, I would say personally, just of a distraction more than anything else.
Understood. Well, I appreciate you going off on that little tangent that I wanted to just cover. But what else are you seeing out there?
I'm seeing the metals and if the metals can hold these gains, I mean they're not exactly up 5-10%, but if gold and silver can largely hold these moves into next week, I think that gives a little more credence to the idea. Maybe the Federal Reserve is trapped a little bit. In other words, maybe they can't raise, maybe to kind of justify their own policy. Maybe they can't raise for whatever reason. But if the precious metals continue to get a little bit of a rotation here, I think that's something I'm watching. They've been very tricky, and crude oil I know is down today. USO, right. The ETF is down more than 3%, but it's still largely consolidating its run up off the late August lows. So I think it's still premature, I think, to say that crude is necessarily breaking down per se. I'm not so sure that's the case or that's true yet. Technically, natural gas is a heartbreaker just going through commodities here. And look, there's still, I mean, that's what we do inside the services. Remember, we keep a running list of relative strength names. I mean, you look at Amazon. I mean, you look at WLD. You look at some of these names which are holding.
I'm sorry. I just wanted to clarify. You kind of broke up there a little bit, at least on my end. The second one was Buffalo Wild Wings, right?
Yeah, and it's not like every single casual diner like Buffalo Wild Wings is doing great. That's not really the case at all. I mean, a lot of them, like Habit Burger and Shake Shack, have been hit really hard. And then other ones which had been strong previously, like Red Robin, RRGB, that ticker, that is not doing much of anything. But a name like Buffalo Wild Wings, I think, is right up there with Chipotle in terms of being pretty good, solid technical charts in the casual dining space. It doesn't mean, I think, when you observe relative strength names, when the market is kind of corrective like this has been, even if we don't sink into a really deep correction or a bear market, it doesn't mean you need to go right out there and buy them, let's say, per se, because it's not like they're screaming to new highs on a daily basis in momentum trend. But I think you do want to at least keep a refined, cogent list of actionable relative strength names in the event that the market, let's say, immediately gets its act together across the board. And let's say we do get that. I mean, I think that's a lot of the bull argument. Probably one of the bull cases here is that we'll maybe just flop around here a little bit sideways more, and then we'll get setups, and then into the holiday season we'll get this jubilant rally. I mean, I would say that's probably one of the main bull cases here. If that happens, I think, again, you have to kind of stay rigorous and do your due diligence and refine that list of names holding up well. Obviously, a lot of the premier names in the NASDAQ, there's really, when you look, Facebook, Google, there's really nothing wrong with the charts per se. So the issue is, are they holding up before they succumb? It's almost like I said in a video for members today, it's almost like, Bob, when you watch, the Summer Olympics, right, and you watch a relay race, that final leg of the relay race, you usually put your fastest runner. So let's say Google and Facebook and these leaders are the fastest runners out there, the leaders, the final leg of the relay race. it's, almost when they see the baton coming to them from the prior runner in that relay race, they start to they start to jog, they start to run, they start to get in motion, and they're waiting for that baton to catch up to them before they can go home free, so to speak, right, and win the race. And so I think what we're waiting on now is Facebook, Google, Amazon. They're the final leg in this relay race. They're the market leaders. They're the fastest runners the market has, growth leaders, institutional sponsorship. And they've already started kind of jogging forward now. And they have their hand back out waiting for the baton to be passed from them. And the issue is that runner or the market, the market at large is the runner, running up to them, the transports, the energy stocks, now the financials getting hit, the semiconductors. And the issue is, will the market actually hand off that baton to the Facebooks and Googles for an easy run home to win the race, or will they fumble the baton and drop it, or have some kind of wipeout and not even get the baton to Facebook?
Kind of like the U.S. sprinters.
Yeah, exactly. Think about that versus Usain Bolt or something, and then what would happen is Facebook and Google, it'd be the exact opposite. They would be the marquee issues, which we've seen in some corrections, in some bear markets. They actually hold out and hold out and hold out, and then all of a sudden they just break at the last minute. Think back to October 2007. Not to pick on Jim Cramer. I mean, he's great, but he had those four horsemen in September, October 2007. It was, I believe, Apple, Baidu, Google, Amazon. I think it was something like that. The four horsemen of the NASDAQ, right? And they just kept going higher and higher and higher as the market was topping out in September, October 2007. So what was happening was it was just like potentially this setup, if that's how this goes down, where you had them holding in well, acting constructively. The bull argument would be they were just basing before they go higher. So they were the four horsemen, right? Oh, you got to be in them. They're the leaders, and they're great companies, and they're great this, and they're great that. But it wasn't so much an issue of Facebook and Google individually. It was a broad market construction issue in the sense that what was happening was the market was deteriorating below the surface. And to go back to that analogy, that second to last leg, the third leg, let's say, of a four-person relay race, couldn't even deliver the baton to Apple, to Cramer's four horsemen, Apple, Baidu, Amazon, Google. So the baton never even got to them, and then what happened was the rest of the market started to deteriorate even more, eventually sinking into a bear market, and then finally the four horsemen succumb. So you can't always look at the leaders as though nothing's foolproof in markets, right? So that would be an example of a wrinkle on the idea that you always have to follow the leaders. There's no such thing, I think, as always in markets.
No, I mean, I think you raise an excellent point, and a point of caution to people that have only been in this market perhaps for 7 years or less, and have never really seen any type of bear market. And I mean, basically, if you just kind of outlasted any of the slight blips, even the larger blip in 2011, you've done extraordinarily well.
Yeah, I mean, a big part, I think a big part of speculation and gambling in general is that grind. I mean, there is a lot of smoke and mirrors into this whole image that, as a speculator, as a gambler, that it's some glamorous kind of a profession or glamorous, sexy lifestyle. I mean, I think it's a very dangerous mindset to have. The reality is, oftentimes it's a grind. I mean, it should be a passionate grind. I mean, if you should love what you're doing in terms of this, or it's going to be, I think, all the more difficult. But especially when you're in one of these potential transition phases, right? The bull is potentially transitioning into a bear, or even if it's not, the bull is trying to repair itself before the bull stages another leg higher. I think that is a I don't think that's a particularly controversial statement, what I just said. That even if you are a raging bull on the economy, you think the Fed or what the Fed's failure to raise rates is still a great tailwind. You think low interest rates is a great tailwind. You think the U.S. economy is on the mend, or you think the global economy really is going to blow over. All of these bull arguments fine. I mean, I don't dispute that, let's say, on its face. Even if you think that, when you look at these charts technically, the S&P 500 index below declining 200-day moving average, I think you would have to agree that the bull is maybe in the process in these seasonally weak months, September, maybe October, of at least resetting itself before you get your bullish year-end rally. And again, that's a bull case, right? And then the bear case is we're in this transition phase from bull to bear. But that doesn't mean, as I think a lot of baby bears have found out in the last couple of weeks, that doesn't mean it's an all-you-can-eat buffet on the short side, because I think that mindset has taken a really big hit as well. So I think you and I talked about this, Bob, a couple of months ago. There were plenty of really quote-unquote smart people who saw the debt bubble coming in 2007, 2008 especially, right? There were really smart people who saw the housing bubble coming, who saw the inflationary head fake lead to a deflationary crash, which is what happened with crude oil going to $150 a barrel, emerging markets rallying and then crashing, the shippers rallying and then going parabolic and then crashing in 2008. But guess what? By the time the main event came around and that bear market came around, they were either out of the business, broke, or they didn't have sufficient capital to really make a dent when their thesis finally came to fruition. So there's the discipline of timing too, which is, again, a really grinding, decidedly not glamorous, decidedly not sexy part, I think, of trading and gambling, which requires you to at times be kind of a really vigilant spectator and maybe not much more at times until you get the setup, right? So
Absolutely.
I think that's a big part of maybe what's going on now, as opposed to coming in today and saying, well, look, I want action. I want action. Like, I want to throw something on here. Yes, you can take your shots, but I think they have to be done in a very careful manner. Position sizing, firm risk management, firm stop loss, adherence. I mean, all of those kinds of things, which, again, I know they've almost become, in this age of Twitter finance, they've almost become platitudes, and it's very easy to poke fun at that, especially when you've been in a bull market. But I think what some people have found out in recent months, I mean, there's nothing funny about this kind of volatility when you're betting with too much size and you don't keep that discipline, because I've always felt like position sizing is your first and last line of defense and risking your capital. So, right. I mean, because you're really, if you're oversized, you're at the behest of any of these, and we've seen a lot of crazy things happen, a lot of crazy news come out. I mean, with overnight, I mean, how many times, Bob, have you seen usually the BOJ, but some central bank come out in the middle of the night and just shock the futures one way or the other?
I couldn't agree with you more. I mean, if you're a bear and think you're going to just get filled up and you're just going to eat heartily and live like what John Paulson and that Dr. Bubel or whatever his name was, the guy from Vanderbilt, I think you're smoking a lot of crack. But I mean, I'll give you, for instance, for me yesterday, I went, I saw the market failing. I got short at 1985. I mean, on the SPOOs, and I took it for 6 points. Now, people can criticize me. I could have got 35 points on it had I held it, but I just don't have that level of confidence.
I think by definition, I mean, take a step and just think about this for some of the listeners out there. By definition, I mean, this is what I never understood, but I know it's tough to have sometimes for many people, especially when a lot of those bears had deeply held convictions that we were going into a bear market and a debt, deflation debt bubble, but they were just too early. They were shorting aggressively in 2005, 2006, 2000, even parts of 2007, which were really favorable to the bulls, at various junctures in 2007, and they were cleaned out. But take a step back and look for the forest for the trees. By definition, if we are going into a deeper, more established bear market, I mean, if you do, let's say you think the S&P 500 index is going down to, I'm not talking about 666, I'm not talking about that. I'm not talking about the March 2009 levels. Let's say you think the S&P is going to 1,300, 1,400. That's a bear market by any standard, pretty much, right?
Yes, indeed.
So if you think that, unless you think every single day is going to be like a 1987 crash, then by definition, there's going to be plenty of time to lean into some shorts. There's going to be plenty of time to build your short book. Of course, you're going to have to trade around it like all bear markets, but wouldn't it be more prudent to wait for, let's say, I don't know, something modest for a bear market like the NASDAQ Composite Index to start having a smoothing out, if not a declining 200-day moving average, which it doesn't have yet? Okay, so that's an issue. The biotechs, yes, they could be the last to crack, which I know is what often happens. As I talked about myself with Google and Facebook and Amazon, but I think you should. It's usually correct to wait until at least that 200-day moving average is maybe smoothing out a little bit instead of still rising, which it is. So that, again, there's no need to kind of force it all in there. There's going to, I mean, it's a process. I mean, that's what they say, right? Topping is a process if that's what this is, and bottoming is an event. But by definition, if you're really a short seller chopping at the bit now, you might want to think about that. By definition, there'll be, and what happens is as a bear market becomes more established, and bear markets, of course, are inherently more volatile than bull markets, right?
Right.
Indeed. But even with that said, as the bear market becomes more established, I mean, you think back to 2008 at various junctures, as the bear becomes more established, it almost becomes not easier, but a little more of a favorable tape to trade than the early or the late, especially the late stages, of course, when we're bottoming. But even the early stages, I mean, think back to late 2007. That wasn't an easy slam dunk short either. I mean, many parts of the market took until commodities until like the second quarter of 2008 before they even topped. So if you were shorting potash in early 2008 under the thesis that equities had already topped out, well, guess what? You were correct, because the S&P 500 index topped out in the second week of October 2007. But guess what? You still got your tail handed to you by shorting potash, because potash, ticker symbol POT, kept going higher, I believe, until June 2008, and
That's right.
It showed no mercy to short sellers. See, I think you can't look in terms of black and white at the market at times. This is one of those shades of gray moments. I think it's been that. My opinion has been it's been that way for a while. Yes, there have been some days where the market, let's say the NASDAQ in early July, the NASDAQ in early June, the NASDAQ looked like it was on a mission to go 10, 20, 30% higher, and really I would have been left out, underinvested. But again, I was looking more so not at the NASDAQ but at the underlying health of the market, and I was still seeing a narrow selective market with deterioration in the transports, energy, even the semis. A lot of high-yield corporate paper junk, a lot of bifurcation, which we talked about too. Really, really strong parts, but then really weak parts, and typically that ends badly.
Well, I mean, one of the things I think you have pointed out to your members, and certainly a point I believe strenuously in, is cash is a viable position.
Absolutely.
Sometimes it's best to wait.
Absolutely. I mean, there's this idea. There was a great. He passed away, but there was a great. I used to play poker with a gentleman named Barry Tannenbaum. He was an accomplished cash game poker player. So not tournaments, but cash games in the casino. Very high level poker player. De Bellagio and all those big limit games back in the poker bubble last decade. And he gave this great lecture one time, basically saying that nobody or very few people drive to the casino. I mean, who would actually, especially you get on an airplane, you fly to a casino, maybe in Las Vegas, you get in your car, you drive to a casino. Very few people are going to do that with the intention on exuding tremendous patience, right? I mean, you're going to do that because you get action. You get the free drinks. It's action. It's fun, right? You want to gamble it up, and that's great if you're doing it for fun. But if you're doing it day in, day out, and you're taking it seriously, I mean, the truth of the matter, to circle back to what I said about not being glamorous, not being particularly sexy, is that the harsh reality is, and I think this is going to be probably not what a lot of people want to hear in this day and age of Twitter finance, especially some of the newer traders who started trading options in 2013, that kind of thing. the harsh reality, I think, of any form of gambling or speculation. You think about professional gamblers at the racetrack, with their race cards, waving it up, cheering the horses on. But the reality is, the harsh reality is, there's necessarily is likely to be long periods of time where you're just waiting and waiting and waiting for the right bet to come along, the right spot to get involved. I mean, yeah, you can take little shots here and there, but in terms of really leaning into a market, my philosophy isn't for everyone. I'm sure there are plenty of people who disagree with what I'm saying, but my philosophy is that they're going to be necessary. And this happens to be one of those times where I'm just waiting for the right spot to lean into the market. It's not always going to be that way. I think the market always changes character eventually. So this idea that the market has permanently changed character, I think, I think that's just a variation of saying, this time it's different, because it's not. The market, the one constant is that the market's always changing, right?
Absolutely.
But I think that's a harsh reality. I mean, again, this, Twitter finance is like a casino in some respect, because it's like a slot machine, right? You see, like on TweetDeck, you see the way the tweets come down. It's almost like a slot machine with the numbers, just constant motion. And that is a stimulant, maybe too much stimulus in and of itself, I think, where it kind of stimulates you so much. That's why with my private Twitter feed for members, I try to keep it no nonsense and just focus on idea flow and no fluff, just going right to cut out the extraneous stuff, which you might see otherwise.
Right. Hey, I just wanted to hit on a couple of topics before we finish up here. We've been going almost a half hour, but one topic that you have brought up, and I know that you're keenly aware of, and it also relates to what happened with the Fed, perhaps. But that is the financials, both large financials and what we kind of call regional banks. KRE, I think, is the symbol, the ETF.
That's right. I mean, typically, the old Wall Street axiom is that banks typically do better with rates rising, the yield curve, that kind of thing, right? But I think we're seeing that. We're seeing a pretty typical, what you might expect, sell-off. With the Fed standing pat and refusing to raise rates, the banks are the first to get noticeably hit. I mean, XLF down 2.2%, KRE, the regional banking ETF, down 3%. Maybe they want those higher rates even more, typically. The regional banks were really interesting because into the summer months, they were holding in there. They were acting like they expected their rate rise, right? They expected the Fed to raise rates. And then I think what started happening was over the summer, they slowly realized that the market was not pricing in an extremely high probability of that happening, right? And so we're seeing the fallout from that. I think we're seeing the best way to describe it, I think the most objective technical way to describe what's happening with the KRE and the XLF is they're seeing the initial fallout from the failure of the Fed to raise rates, but it's important to note they were already technically in hot water. There's a big difference, in my opinion, in the markets between, let's say, when you get a healthy chart or a healthy bull market, and then you just get one day. I mean, it happens in bull trends all the time. A healthy bull trend, it happens in it happens a lot. You get one day where it's just this nasty sell-off, down 2-3%, and then what happens? The market, the next day, the market just keeps grinding higher like nothing ever happened. I don't think that's what's happening in this case with the financials or the regionals, because they were already troublesome charts. I mean, I know it's not a big bank per se, but Berkshire Hathaway is still a major component of the XLF sector ETF for the financials. And if you look at the A shares, they topped out, I believe, in December 2014. Berkshire is a chart which is in hot water. And I'm saying that as someone who was wildly bullish on Berkshire back in 2010, 11, 12. If you were reading my work back then, I thought it'd be a great long-term investment. But I did flip negative on it when it started getting out of line back in, I would say, in 2014. Was I probably early? Yeah, I probably was early in ejecting from Berkshire, but all of that run-up has basically been given up. It's below a declining 200-day moving average. And Berkshire, for a long time, whenever Goldman Sachs or some of these banks, at one point Citi, Bank of America had great run-ups in July of this year. A lot of people, I think, were cherry-picking that and saying, aha, look at that. You can't be bearish on this market. This market's going to new highs because those big banks are acting well. But you didn't hear that analysis about Berkshire. I think, it's amazing. It's amazing what a bias will do, confirmation bias will do, because whenever Warren Buffett is out there saying something really bullish, I think you see a lot of people cherry picking that. But when Berkshire Hathaway's stock is in hot water, technically, it's kind of conveniently swept under the rug as being, the argument you often hear is, Berkshire is a defensive name. But that's not true. It would have been true maybe a decade or 2 decades ago. But Buffett's actually been acquiring more economically sensitive businesses, I would say, in the last 10, 15 years, if you actually look at who he's been acquiring. So I would submit to you, Berkshire is actually more economically sensitive than people are willing to admit. And, if you want to backtest that, go back, I would say, to 2009. There was a moment in 2009 when Berkshire Hathaway was going to fall off a cliff into the abyss, just when the market looked like it could have too. And at the last minute, right in March 2009, Berkshire bottomed with the market in 2009. Berkshire wasn't one of these names that bottomed in October 2008, like some names did. Berkshire was trading in unison, synchronized seemingly with the S&P. Berkshire, my personal opinion, was that the market was almost waiting on Berkshire to see if Berkshire was going to fall into the absolute abyss. It hit $70,000. I believe it hit $70,000 a share in the A shares, and then at the last minute it snapped back, and that was a bull market. That was the bottom of the bear market. But I think Berkshire is much more economically sensitive than people would have you believe. So I did want to work that into the analysis. Bullish or bearish, by the way, that goes both ways. I mean, I can't cherry pick either. So, and that's one of the reasons why I was bullish on Berkshire in 2010, 11, because I felt like Berkshire was kind of signaling that the bull run had more to go. But now what I'm saying is the technical damage that Berkshire Hathaway has sustained in the last couple of quarters, I think you'd be remiss not to seriously consider that and monitor that.
No, I mean, I think you're absolutely right. I mean, huge railroad business that they've added. They're very large in home construction, kind of across the industry. So no, I see it, and I just wanted to bring that point to bear because I know that you have made it continuously, and I think it's a very important point for people to key in on.
Yeah, I do think Berkshire. I mean, there's always these old Wall Street axioms, as General Motors go, so goes, Motors go, so too goes the market. As IBM, Big Blue, all these bellwethers, right? Big Blue, Intel, General Electric, and that could still hold true. But I still think with Buffett's acquisition and Munger, their acquisitions in the last 10, 15 years, I still think they're much more economically sensitive, and I would point to that 2009 price action, which obviously was a bull. That was a scenario where it was helping the bull case at one point. Berkshire, I could go through the whole analysis technically, but I think Berkshire responded in a wildly bullish manner. Obviously, in 2009, even before it actually did bottom, it was actually responding to its prior decade lows. When we know the S&P had already breached, I think, its own 2002 lows. So Berkshire was a much bigger tailback than I think people would normally think. And what I'm saying now is Berkshire's chart is still in hot water. So I would still pay close attention to it, whether it recovers or whether it continues to sink here. My opinion is that Berkshire is a pretty big tell. So.
Yeah, I mean it is the largest component of the XLF. Am I correct?
It's either that or Wells Fargo. I think they usually rotate, but I know them and Wells Fargo are right up there.
Okay, yeah, and he not to mention that Warren has sizable stakes in a number of banking firms as well.
I think, and he loves Wells Fargo. I mean, he does love So there's a lot of there's definitely I don't know an incestuous relationship with all of these firms that are related to Berkshire, and considering they're all sizable components in the XLF, I mean, that matters now. I mean, you can't, I don't think you can have it both ways. I mean, I think you have to acknowledge that Berkshire means something. I mean, not just when Buffett goes on CNBC and says something, I mean, that's really great. But the price action in Berkshire stock, that matters, you know?
Well, I mean, I think it can be safely said it's kind of a barometer for the U.S. economy in many respects.
Yeah, I mean, I think 20 years ago, 20, 30 years ago, I think there was a very colorable argument to be made that Berkshire was a much more defensive kind of firm. I mean, maybe not quite like a tobacco firm, but I think there was an argument to be made that Berkshire was much less sensitive to the economic cycle. But now I think that's much less the case. Yeah.
I think that's clearly the case. I mean, Buffett has spoken at length in his annual letters and on TV about the difficulty of deploying cash. They have a number of businesses that throw off enormous amounts of cash that he's constantly challenged to reinvest and to make money. So I think it was somewhat natural for him to, go in other areas. But, we've dabbled in financials perhaps enough. We're kind of reaching the end of our time here. I don't want to go take you too long, but are there a couple other areas that you wanted to definitely discuss?
Well, let me. I think we hit the main points. I mean, bonds have been, bonds are still catching a bid here. Treasuries are still bid up after, obviously, as you might expect, with the lack of a rate rise. I'm looking to see rates on the 10-year. They're still above rates, obviously inverse to prices. They're still above the 2015 lows. Rates on the 10-year from January and February, and they're still above the 2012 lows. So I'm looking to see if this rally in bonds stops short. That, to me, would be a big warning sign. But I know bonds have been, I'll be the first to admit, I've been looking for it. It just has not happened. Bonds, I know there have been times like 2000, the taper tantrum, where bonds have shown signs that maybe this bull market that they've been in since Paul Volcker fought to back off inflation in the early 1980s, maybe, it's kind of long in the tooth, which has been going on for 3 decades. But I would need to see, I think, for my analysis, rates on the 10-year over probably that 3% threshold. If we see that again, that to me, then I could point to that. I would have much more kind of technical, meatier evidence to say, okay, now we have something to work with in terms of a major multi-decade bottom in rates and by inference a major top in bond, in treasuries.
Yeah, I mean, obviously that creates a whole bunch of issues, for the U.S. government and no less, sitting on $19 trillion of debt.
Yeah. Well, if I may, Bob, I want to drill home one important point about Berkshire. I think you've also seen Charlie Munger, Buffett's partner, really try to talk down expectations about the stock in recent annual meetings and his comments. He's saying things like, the only thing we can guarantee you is that the future Berkshire returns are going to be nothing like the past, incredible returns. I think what's happening is they realize they have a much more economically sensitive stock on their hands, Buffett and Munger do, in terms of Berkshire. Right. And I think what they're trying to do is talk down this idea of they don't want momentum traders clearly in the stock, and they don't want even people investing probably for 3-6 months. They want people who are just going to set it and forget it and buy it and never look back. I mean, that's obvious, but I think they've always, I'm sure they're going to argue they've always wanted that, but I think they want that even more because I think they know they might have potentially a much higher beta, a little bit more of a higher beta stock than they might have become accustomed to in the past. So.
I think that's a very fair point. I will say, however, that those warnings about earnings and about the value of the stock relative to earnings, they've been basically saying that since late 90s, I think, when they kind of started this whole little dribble into more economically sensitive stocks, I'll say.
Yeah, I completely agree, Bob. But yeah, I think we hit a lot of major points today.
Excellent.
So Yeah, thanks.
Well, I again like to thank you for joining us and giving us your time and your expertise. It's always appreciated. Follow him at Chess and Wine on Twitter. He does have a service that he runs. I am a large proponent of it. I have followed Chess and been a subscriber to services that he's been employed by for a number of years, and I recommend him highly. I think he is a incredible worker and incredibly bright. So with that, folks, I thank you, Chess, and I will leave it at that. Everybody have a safe and good weekend.
Thank you.